support and resistance, because it's one of the most important concepts that you can master when you're building your foundations or your building blocks to trading success. Now, the idea of support and resistance is not very complicated. It's fairly simple. When discussing it in the context of the stock market or a CFD market, a Forex market, it defines a level at which buyers and sellers step into a market or where the law of supply and demand comes into play. Imbalances in supply and demand create support and resistance levels. For example, when an overwhelmingly high number of buyers or an increased demand step into the market, an indication of support is being put into the market. Conversely, a large number of sellers, or when the supply drops, indicates there is an overhead resistance preventing that asset from moving higher. Now, that doesn't mean it has to be 10 minutes ago, 15 minutes ago, 30 minutes ago, a week ago, 6 months ago. There are certain prices in an asset's movement that have these integral points where price has a problem moving up farther, or price falls down, or when price moves up and it eases back down, it always seems to stop at that level. Like, for instance, we know that 99 cents is a psychological level. So stores put everything on price at $2.99, $3.99, $4.99, because they know a consumer thinks about it at $3, not $3.99, because they don't start thinking $4 because they haven't heard the word for. So they know 4 is a resistance level, but they're safe at $3.99. Gold historically has a problem at $1,000. It rallied up, has a problem at $2,000 coming way back down. It has a problem now coming below $1,200. And if you look long term, there could be a very important level always at $990. Okay, so whenever it falls and tumbles, it always stops at that level. But we also know it has a very difficult time reaching 1,000. But that could be more recent. These levels can be extended from the far past into the future, because these levels come into play only when price is near that level. So gold has been way above $1,100 for a very, very long time. So if gold ever started to fall down to $1,100 or a little bit lower, we'd have to look back over a long period of time to find out what price was significant in the $1,000, $1,100 range for gold traders in the past. So the price levels which create support and resistance in an asset only tell half the story. We mentioned a key phrase, overwhelmingly high. So volume is the second half of the equation and shows us the strength behind the buying and selling and support and resistance levels. So in other words, when we see gold, and I'm just using gold as a hypothetical, we could be talking about Bitcoin. Okay, we could be talking about General Electric. We could be calling about Amazon last week when Trump was talking about it. Okay. When price falls, there's a point where the buyers are exiting the market. Okay. Or they're not entering the market. So nobody's buying, and sellers, in order to sell, are having to lower their price. But there is a price point as the price falls where a buyer's going to say it's a good deal, and they'll start re-entering the market. Or when price is going up, you'll see sellers start selling, or people that are holding position start selling. Because if you bought gold at 1,100 and you said, hey, I'd be happy at gold at 1,200 and gold moved to 1,225, you're saying, I'm going to take my profit and get out of the market. I'm happy. So you start selling your assets, not because you think they're going to fall, because a good trader has already set his target point. There's a point at which he says, okay, I'm going to exit the market. And so when they know that 1226 is a key psychological level that gold has a problem breaking through, and you're happy at 1225, you sell at 1225 and get out of the market. You don't need to be in there to play any longer because you're coming up to a level where you don't think it's going to go through. So as you sell, but there's no buyers really buying because the price is too high for them, the price keeps falling down. At some point, a buyer says, oh, well, look, it had no problem getting to 1225, and it's down to 1,200 now. I'll take a 25-point play, and they buy back in the market. And they eventually put that price back up. but this forms your levels of support and demand. But because there's many levels of support and demand, they are information lines or information zones or information areas, that the only way to know if these levels are going to hold, or because price could fall right through a support level, or it could run up right above a resistance, because there's no law that it has to stop there. So what tells you when that key factor is coming in is volume. So in other words, if price is falling down in gold and it's coming towards that $1,100 level, and you know that's a very strong support level, and you see buyers entering the market because you see volume going up, that tells you buyers are entering the market. That tells you that most likely that resistance zone, that support zone, is going to hold and gold is going to bounce off of it. So you're always using support and resistance with volume. Now, I understand you need probably a better explanation of what the support and resistance is. So when we talk about these floors or tops, these ceilings and floors, or we talk about support and resistance, let's close our eyes and think about an elevator. Now, when you step into an elevator and you push the button to go up, and the elevator starts to rise, what is holding you up? What is supporting you as the elevator is moving up? The floor under your feet. Now, you got on the elevator on floor ground level and you push 5, but the elevator goes up to the first floor. You needed to go up 4 more floors. What do you have to do? You have to push through that ceiling above your head to get up to the next floor. That ceiling is your resistance. When you move above that resistance level, or you break through that ceiling becomes the floor under your feet and becomes your support level. So when price is moving up, the floors are pushing you up, the ceilings are resisting, you're breaking through the floor, and it's becoming your next resistance level. Now, this is a simplistic explanation. Now, remember, it's the exact opposite when that elevator is going down. Because to go down, what do you have to do? You have to push through that floor to get to the next floor. So that floor is what? Is your resistance, because you're trying very hard to get through it. When you break through it, the ceiling is your support, and the floor below that is your resistance again. Because your resistance is what you're constantly breaking through. Support is what's holding you up. Now, let's talk about this in a little bit better. In fact, you're saying, oh, well, if I'm just pushing the button to the 3rd floor and I got to go through the 1st floor, say, I know where those are. Okay, I know when it reaches the 3rd floor. Well, it's not that easy. Because now, let's say I painted you gold and shoved you in that elevator, and now you're gold. You don't have any hands, you don't have any feet. You're stuck in that elevator. You can't push any buttons on the wall. You can't get out. So all you have are your eyeballs that you can observe. So when that elevator door shuts, a couple people get on the elevator door shuts, and it starts going up. In other words, you're moving in an uptrend. But you have no idea what floor that elevator is going to stop on, because you can't push the buttons. Now, when that elevator door does stop and the door opens and those people get off, you look out the door and you see you're on the 1st floor. But you also observe that floor. And now what you've observed, it's a big, beautiful set of office suites with dark wood paneling, and you can see the signs for doctor's office, lawyer's office, accountant's office, dentist's office. So you know there's going to be a lot of traffic during the daytime to that floor, right? So you can also figure out, oh, most of those offices will probably open around 9 o'clock. So if it's before 9, most of those people aren't coming to work yet, and their appointments aren't coming in that early. And if it's after 7 o'clock at night, most likely there's nobody going to that floor, very little traffic to that floor, because all those people have gone home in professional offices. the door closes again, you don't have any control, and it goes up a couple more floors and opens up, and you see it's the roof deck. Well, what do you see on the roof deck? Well, you see these beautiful balconies and these smoking sitting areas for people to sit outside and smoke with ashtrays. You also see vending machines inside. You see some couches. You see some tables and chairs, and you realize, oh, this is upstairs where people who brought their lunch can sit up here and have lunch. They have, they have coffee machines, soda machines, and it's not a restaurant thing. It's just where people who are working in the building can go eat lunch. And you also notice there's all this place for smoking because people coming up, they're going to buy coffee or Coke or sit outside and smoke a cigarette. So it's going to have a lot of traffic up there on bright sunny days, especially when all the people are at work because they're all wanting, those that smoke are all coming upstairs. At lunchtime it's going to be fairly busy. And you also know when it's a beautiful sunny day, there'll be a lot more traffic going up there than on a rainy, wet, cold day because people smoke less, so travel up there. So you're starting to analyze the markets by knowing time of day, by knowing the volume of people, by doing some analysis. You can figure out how often that elevator will stop at first floor, or what the odds are when that elevator is rising is to stop at the first floor. It stops at first floor, people climb on. Does it stop at the second, third, fourth, or does it go straight up to the roof? Well, the odds are if it's lunchtime, people are getting on the first floor, so that means they're most likely employees or people coming to the doctor. If they're not going down to leave, where else would they be going? Most likely up to that roof to smoke. So you can then, like I said, start making some analysis of the markets. So indicators are a great addition when looking at support and resistance levels. And what are indicators? They're your analysis of the market. You have your Fibonacci levels, you have RSI, you have stochastics, all types of indicators you can add on. Okay. And if you think of support and resistance as your fundamental levels, these lines are like reading a chart, putting a trend line, looking at volume, and looking at support and resistance. These are not really trading strategies. They're more like taking that chart and making it a roadmap, understanding what price action on that chart is trying to tell you. Okay. Not a strategy, not other indicators, not entry and exit points. It's trying to help you no matter how you're trading, no matter what style you have, no matter what period, we're all trying to figure out where to enter and exit the market, at what levels we should, because even if you're a strictly fundamental trader, and Facebook took a big plunge last week because of all of this data breaches and Mark Zuckerberg being called to testify in front of the Senate and Congress. And yesterday he made his official apologies, went door to door and meeting senators and congressmen. Today he will be making his first presentation, his opening speech, and start being questioned by one panel, tomorrow by a different judiciary panel. And we've now seen, based upon his headlines yesterday, what he was saying to the senators and congressmen yesterday in private meetings, that he's going to take a very apologetic view, take on the responsibility, saying it was his personal lack of good supervision, and hopefully, kill this thing in the bud. Well, if you think it'll kill this thing in the bud, and you want to buy Facebook, how do you know at what point you want to buy Facebook? What price level do you want to buy Facebook? Okay, and so if you see Facebook that fall down to, I don't even know what it's trading at, 140, say, is that a point you want to enter the market? Well, maybe the support level is at 138, so maybe you don't want to enter to 138. Also, maybe you want to do a limit order on your platform. You want to tell the system to buy at a certain level. Okay, you don't want to sit there and watch and just push a market level. So what do you want to do? You would buy right below that next support level, or tell the system it bounces off that support level, start buying, because that stock's is now turning around and going up. But if the stock breaks that support level going down, his public appeal wasn't working. So you want to know when it starts bouncing back up, how high will it go? Well, you would use these resistance levels for each different price level as your indicators, as your alerts. Okay. Now, since support and resistance levels act in a cylindrical fashion, meaning the price will bounce off the highs and the lows of a range, oscillators fit best to help add it into your trading strategy. Oscillators, like support and resistance levels, will bounce from one extreme to the next. So we have two very popular ones that work very good with support and resistance levels to find entry and exit points and understand trends. And that's RSI and stochastics. Now, if you think of support and resistance levels as key junctures where the forces of supply and demand meet, in the financial markets, prices are driven up by excessive supply and down by lack of demand. Supply is synonymous with bearish and selling. Why? Because that means there's an overabundance in the market. Doesn't mean we have too much wheat or too much euros. It means there's too many sellers or too many buyers. Okay. So when demand is down, because buyers are creating demand. So when demand is up, that's very bullish because the buyers keep wanting to sell at a higher price. When the demand is down, then it becomes bearish because why? Because there's more sellers in the market than buyers. So who can dictate price? So imagine what everybody says, the best time to buy a car is the end of the month because the salesmen want to make their commission. They want to close out their month. So they're looking. So what happens is they end up with a huge amount of demand at the end of the month because psychologically people think they get a better price at the end of the month. But technically they don't because there's more buyers at the end of the month. Okay. When a new model comes out and there's demand for it, the price, or they don't negotiate much on price, so they actually over the years have sold cars over sticker price. But at the end of a model year, when there's lots of them sitting on the lot, or say when Volkswagen had the scandals, why could you buy tons of Volkswagens dirt cheap? Because there weren't buyers in the market, so the sellers had to keep lowering their price. So remember, support is the price level at which demand is thought to be strong enough to prevent the price from declining farther. Support levels are usually below the current price, but it's not uncommon for a security to trade at near support. Resistance is the exact opposite. Resistance is the price level at which selling is thought to be enough to prevent prices from rising. So resistance levels are usually above the current price. Now remember, when price is moving up, the next level is its resistance. And when price breaks through that resistance, it then becomes the support level or a support level. So when price is falling back down, that level becomes a resistance level because in order to continue that decline, it's got to break through there. So it is supporting in a downtrend, it is the exact up. So up here, when price moved above it, it was a support level. It was supporting this upward rally. So they actually do reverse themselves. Again, just think of it as an elevator. But where do you get these support and resistance levels? Are they just magic lines that appear on your charts? No. So there are several ways that we can get these. These are not just random lines. Okay, they just don't fall out of nowhere. Now, there's many ways we can get these. Okay. For short-term traders, we are more concerned with the short-term support and resistance levels. And these can be located by looking at a price chart. And remember, when price is moving, and I lecture this in all my classes, price doesn't move in a straight line like this. Price moves in uptrends or downtrends. That's a level of push and ease, push and ease, push and ease, push and ease. And each one of these pushes establishes higher highs. When it eases back down, it should form a lower high, then a next higher high, and a next lower high. If we locate in the previous move the swing highs and the swing lows, okay, from this move and draw a line across it, we can find other swing highs and swing lows in the forward move common to that price level, that gives us a resistance level, or as price is moving down here, it was a support level. Bounced off, came back, is still support, broke through, it came down, find a new support level, came up. That old support level here was now a resistance level. And we can do this by using swing highs and swing lows established through the price movement from using the lower lows and the lower highs. We have to find at least two common price points, and the more the merrier, and extend those lines forward. And those lines can be extended forward for days, weeks, hours, or months. Those price points are always good, because what it tells us, when the price again is in this area, so say we had established a support line here from there, and then we came down here and we found, and we were able to establish a new support line. Okay. Now, once they're established, forget this. Price falls all the way down here. A week goes by, and then price starts moving back up, and it's back in this range again. These support and resistance lines can be moved forward and become active again, because these are the support and resistance levels of the floor above and below wherever the price currently is. Now, the more times that price has touched that level, the more valid it is. The more times it's reacted to that level, the more valid it is. And the more current those levels are, is the more valid. But sometimes you have to go back for months to find these levels anyway, because the asset hasn't traded in this price level for quite some time. So old levels hold true moving forward. Then my favorite one, and this is how I do all of my trading, is I call eyeballing. Eyeballing, to me, a lot of people say it's too time consuming, it's too difficult, it wastes a lot of time. To me, eyeballing is going back on your chart and pulling your chart back. The first thing you want to do is pull your chart back and look for prices that are around the price that the asset is trading at now. Because you have to go back and see where that asset ever traded in that range again, and look for price points, not swing highs and swing lows, but look for where there's lots of common touches. You know, maybe it was an open, then a close, then an open, then a high, then a low, all at that same price level. Well, that's telling you that price, whether it was a high for that period, a low for that period, a close for that, was intrinsically important to that market, and then extend them forward. So let's go over to a chart and let's see how we can do this in a live chart. So hold on, let me pop up some charts here for you. Okay, let's. Okay, so this is a chart of the euro US dollar. This is today's chart. Now, as we notice, when we're looking at today's chart, we see the euro's been climbing up pretty steadily, and we don't see anything around the price level where the euro is right now that's going to help us. Why? Because it's way above all of its more recent prices. Okay. So it's higher than it's been for the last couple days. So we'll go back on this chart, and we'll just take the chart farther back and see if we can find when the euro was trading at this 123, 124 range in the past. Okay, so we can see around here. Let me just hit these markings off the chart. So we can see somewhere around here, and then especially here might help us with the euro. But right now, when we see this high right here, we don't see any other price that's in common with that price. Now, we did form this high here, and we can see that we may want to draw a line on here and see if we can see any relationship. Okay, but there's really nothing that stands out in this level Although I think we can see a lot of tops and bottoms. Let's see if we just put a straight line on here. Because again, there's no hard set law. There's no, you can have a completely different eyeballing support and resistance line than me sitting across the room from you. Because this is what makes you or me better traders than the guy sitting across the way, is how we can look at a chart and understand the markets. So maybe we can look and see here. See, there's not much in common here. We have a high here, we have a high there, we have a high here, but there's really nothing in common at that point. Now, if we come down to this level, now we can say, look at all of these opens and closes and tops we had back here at the same price. Then when price fell down and it came back up, we have opens and closes right at that same price. So this 123, 311 might be a good support level, but I have to move the charts over to see where the asset is right now to see if that even comes near. Now, we've extended our charts forward to today's trading. Now, look at this line that we extended forward, and look at what happened here. Look how strategically important this price was. From this line we extended from back here, 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 here. All of it was strategically important to that price. Now, this right now can be our support line holding the price up. Okay. Now, we need to find something up in this level here to help us see if we can get, let me get my marker off again, to see if we have something in about the 123.7 level or thereabouts that might help us determine a range, because right now we don't have anything to extend forward. So we're going to go backwards again, but we're going to have to go back past that level because we need a higher price point. So look, we're going back all this way before we even find a price that's even trading. Now we got something. So now price has moved up into this range, but we don't have anything up here really high enough to help us much. But again, we're just eyeballing. So we can put as many of these support and resistance lines we want on a chart. But if I look at this high here, that swing high here, let's extend this line back here. And then I look at these open and close. I have some areas that might have been important to that price level. So we're going to put it on the chart, and we're going to try to extend a little farther back to find when the euro was trading at this range again. Now we can see here, we're finally starting to get up into this range where it was trading about the same price in the past to where it is today. And can we find some level of congestion here? Well, we can find several. And see, you can have major supports and minor supports. Okay. We have a level there. And there. Because we have no, the problem is the farther you go back and the more prices moved higher or lower than its more recent lows, you have to guesstimate. So we have some strategic points here. That's all they are, strategic points. Okay. And again, we've drawn those lines forward. So now we're moving our chart back to where today's price is, because all we're trying to do is get some type of understanding of what's going to happen around the price where we're trading today, since we haven't had any in the past. Because again, it's information. We can call these zones, you can call them a lot of things, but they're just general information. Now, price is still well above any of those lines that we drew on. And see, that's a problem. Then we have to go back farther and farther. Let's see if we can. Oops. Okay. So at this point, okay, we don't have anything. Okay. Now, if we were steadily following the euro, we might, because see, you can draw these lines and leave them on your chart for a very, very long time. Okay. And leave them sit there because they will always become valuable. But there are other ways that we can get support and resistance levels. Okay. The eyeballing is one of them. That's why I told you eyeballing is sometimes time consuming. You might have to go back to a 2-hour chart, a 1-week chart, a 1-month chart to go back far enough to find something, because it doesn't matter about what time period. All you're trying to do is figure out a price that was strategically important to this asset. And at this point, to buyers and sellers in the past. Okay. The second way that we can put support and resistance, and we don't throw out one to replace it by the other. Okay. Because you can have zones, you can have multiples. Because also Fibonacci levels will give us support and resistance levels. Trend lines give us support and resistance levels. But the other way is using what we call pivot points. And these are mathematical calculations. Now, you can get these by using what's called a pivot point calculator, which is kind of time consuming because you got to put all the numbers in the calculator for the highs, the lows, the opens, the close, and it'll do some calculations. Or you can go anywhere that offers financial analysis, whether it's FX Street, Forex Factory, Investing.com, and go to what they call pivot points, a pivot point chart. And a pivot point chart gives you the levels of support and resistance around the current price. Now, we don't want to use these 3 other levels down below because those are system support and resistance levels, and you have to be using, one of these strategies to use it. So we want to stay with the classic. We also want to make sure that the time frame is equal to the time frame we're using on our charts. So our chart is the euro US dollar in a 30-minute chart. So we want to make sure we're looking at the euro US dollar in a 30-minute time frame, and we want to take off of here our next support. Now this gives you 3 levels of support, 3 levels down on the elevator below the price, and 3 levels above the price, and 3 levels of resistance above the price. So for class today, we're only going to take the next level because it's all that we have the time for to put on the charts. And we're going to take what's S1, and that's giving us 123.43. And we're going to take R1, which is 123.54. And we're going to go back and put these on our current price chart. So we're going to take our line tool here, and we're going to make this one a blue line. Okay, and this is the first one is 123.43 off that chart. So we're going to come down here to 123.43. $123.43. It's just about there. Oops. And we're going to take 123.54, which is you want to get them on as accurate as you can. I'm sorry, I'm using a screen, because I'm doing the webinar on a small screen, and 123.54. Okay, so we have our blue lines. which are our support and resistance levels from pivot points. We have our gold lines, which are our eyeballing support and resistance lines. And so now we're starting to define price and price movement on our chart. So right now, price is trading at 123.55, right between that support and resistance level. So we could possibly evaluate that our support level would be here, our resistance level would be here. When price hits to 123.54 level, we don't think it'll stay in this 123.45. That's a very small level. But we think we eyeballed this one, and this was a strategic level. So we've now got some type of a channel around price. Now we can start making some decisions on. If we actually had a short-term trend line on here, we can start using that for more trading decisions. Okay. So all we're trying to do is make some sense out of price action. Because no matter how you're trading, if you thought the euro was going to weaken because it had gained way too much today, and you said this rally is about to end, and you thought it was topping out and you wanted to get ready to trade a short position, you would wait for it to come up to that 123.54 level and see if it bounced off of there. And if you combine that with other indicators such as RSI and stochastics, evaluated your trend line, and looked at your volume, you might be able to say, okay, that could be an entry point for me. So you can now tell your system with using, say, an OCO order, one cancels the other. You could tell it if it breaks through that resistance level and hits, say, 123.55, buy, because then that up level is that uptrend is going to continue. But I think it's going to hit the 123.54 level and fall back down. And you could tell it to initial a sell at the next level below that so that you could take advantage of that trend ending. But see, this is a very well-established uptrend. You know, push, ease, push, ease, push. So it looks like we're probably coming into an ease, and that's going to push back up into that uptrend. But at some given point, the buyers are going to get worn out and tucker down. So what you're trying to do is make something make sense to you instead of being complicated. Okay, you need to be able to understand price. So identification of key support and resistance level is an essential ingredient to successful technical analysis. Even though it is sometimes difficult to establish exact support and resistance levels, being aware of their existence and location can greatly enhance analysis and forecasting abilities. If a security is approaching an important support level, it can serve as an alert to be ever vigilant in looking for signs of increased buying pressure and a potential reversal. If the security is approaching a resistance level, it can act as an alert to look for signs of increased selling pressure and a potential reversal. And what's the word I'm using? Signs, alerts. If a support or resistance line is broken, it signals that the relationship between supply and demand has changed. So as we said, one of the great ways is to find support and resistance is to mark levels in the past where price had difficult times breaking through. As price moves up and down, each price level that is bounced off, it could be a level in the future that price bounces off again, or at the floors of an elevator. Now, this is a manually intensive method and takes time to draw on all the currency pairs that we trade, but it can pay off in the long run. Then again, we talked about locating swing highs and swing lows. Okay. And we can look at the chart and see these, and we can actually see once you get them on your chart, you'll actually see how a price is responding to these levels. You'll be surprised at how good they are and how good you get at drawing them. Now, the more times a price bounces off support and falls back to resistance, the stronger these support and resistance levels become. It creates a self-fulfilling prophecy, and the more often it happens, the more likely it's going to happen again. Understanding the concept of support and resistance, trading ranges, breakouts, breakdowns can be quite valuable to all traders. Support and resistance is one of the strongest and most dependable tools available to a trader. Remember that it's always best to use any tool along with other indicators when deciding whether and or when to take or exit a position. Support and resistance analysis is an important part of trends because it can be used to make trading decisions and identify when the trend is reversing. For example, if a trader identifies an important level of resistance that has been tested several times but never broken, he or she may decide to take profit as the share price or the asset price moves towards this point because it is unlikely that it will move past that level. We also have what we call psychological levels. Like when I was rattling off about gold, and I said $1,000, $1,100, $1,250. Numbers that tend to round off in whole numbers tend to become very important psychological levels. Because if you're a Forex trader and you're an established trader, you might talk about the euro being at 123.5. You might say the euro's at 123.54. But very few people say the euro's at 123.5472. Can't even remember what it is. So you round it off. And what happens is you round it off to 123.5. And then before you know it, forget 123.5 is really 123.500. So you've rounded it off. Also, when people are putting so when you're talking about an asset, you tend to talk about it in these whole numbers or zeros, 50s, 25s. The other thing is when you go to, most people, when they go to set their take profit and their stop loss points, and even when they set limit orders, they don't look at the fourth digit. So they'll tend to say, okay, sell when the asset reaches 123.6, not 123.654. And they'll tend to say, buy the asset at 123.6. Because again, we're dealing in pips and that's 4 decimal points to the right. But these become very important psychological levels. So we have pivot points, we have psychological levels, we have eyeballing, and we have swing highs and swing lows. These are all different ways of establishing support and resistance. They can all be used together at the same time. And what happens is when you have 2 levels that are fairly close, one coming from, say, eyeballing and one coming from swing highs and swing lows, you can actually color in between the lines and call it a zone. Okay. Because a lot of times you'll find that your eyeballing and your pivot point turn out to be almost identically the same. So if they're a pip or 2 apart, just color it in and call, and then it also makes it strategically more important. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us, and thank you for supporting Alvexo and investing.com. Have a good evening and talk to you again real soon. Bye now.